This is the Macro Trend, your daily dose of financial news and how it impacts your everyday life. Happy New Year! While you were finishing holiday leftovers, the global economy quietly reached a turning point. In the first week of 2026, something important shifted in the bond market. It's called the yield curve. It sounds technical, but it often tells us where the economy is heading next. Today, we're cutting through the jargon, why your savings account may finally get a boost, and why cheap mortgages are not coming back anytime soon. Welcome to the Macro Trend. The yield curve just changed. Here's the big story. The US yield curve is now the steepest it's been since 2021. Think of the yield curve like a weather vane for money. When it steepens, markets expect economic growth, but also higher costs ahead. For the last 2 years, the curve was inverted. That inversion was a warning sign of recession. Now it's flipping back. This tells us something important. The era of free money isn't just over. It's buried. If you're waiting for interest rates to fall back to 2% before buying a home, you may be waiting a very long time. What this means for your wallet. Now let's talk about the real impact. This is a tale of two bank accounts. If you're a saver, 2026 could finally be your year. Banks are competing for deposits again. High-yield savings accounts are reaching levels we haven't seen in nearly a decade. But if you're a borrower, the story is tougher. Long-term debt, like 30-year mortgages, is staying expensive. Why? Because markets are nervous about long-term inflation. The macro trend is clear. 2026 is the year of the saver, not the spender. The bottom line. The recession everyone feared in 2025 never arrived, but expensive is the new normal. Here's your move this week. Check your savings rate. If you're earning less than 4%, you're leaving money on the table. This is the macro trend. Subscribe to stay ahead of the curve. I'll see you next week.